Hi, this is Jeffrey Kerr, Kerr Financial Group, and we are back. We had a lot of positive feedback and encouragement after our first video, and I'm very thankful for all those who reached out via emails and text messages, phone calls, and likes on the social media platforms that we posted the video. Thank you so much for doing that, and we're going to try to continue this. And also, please keep the comments coming on ideas and questions and things that we can do better. So, talking about topics for this video, a couple of them that we considered. One was cryptocurrencies. Clearly with all the action going on, the big run up, the recent drop, and just the controversy around it, that was a natural issue, a candidate to talk about. But to be honest with you, I'm not sure I understand that much, and I think it would be probably a lengthy video that would be pretty torturous. I'm not sure anybody would want to subject anybody to it. Another, nominee would be the inflation. We're paying more at the gas pump, at the grocery store, at the restaurant. Lumber and steel and all the cars are going up. Used cars are record levels, and even sad to say, adult beverages are going up too, which is a painful situation. So may come back to the inflation story, but another topic that I thought would be helpful with this video is a question that I get regularly in a conversation. Um, and it's the question is, why are the markets so acting so well, stocks at record levels, bond market doing well, with all the bad news that we've got? So that's the issue I want to try to talk about. And one of the things I think is behind this is the algorithmic and computer model trading. Obviously, computers don't look at the issues the way that humans do. The humans, we want to have that logical connection between a bad headline and a falling market, and it's just so hard to understand when you've got a lot of social discourse and the division, yet the markets continue to go higher. So the computers look at other variables rather. I mean, headlines have an impact, and I think maybe longer term, those variables become headwind to the markets. But in day-to-day trading, or even week-to-week, month-to-month type of time frames, computers look at trading patterns. Looking for a repeat of a trading pattern. They're also looking at things like trading volume. And recently, the markets have been going, when they go up, the volume's higher. When they've been going down, volume's lower. That's a positive sign. Also, the volatility measures, are a big input. And I think rate of change and the relationships between different asset classes, such as bonds, I mean interest rates to the stock market, and the currency market to commodities and stuff like that. Those cross asset class relationships can have an impact, again, that may seem non-obvious and somewhat illogical. And one thing that I think is important, what's going on right now, and one common variable that the models and algorithms look at is, are things getting better? So when we're looking at Q2 of 2021 versus Q2 of 2020, obviously with the data is a lot stronger in 2021, and so it looks like an improvement. And the algorithms, again, one of the factors is going to be, are things getting better or are things deteriorating? And clearly they're getting better right now. Now later on in the year, that's going to be more challenging as 2021's third and fourth quarter it had some activity and some rebounding as things kind of began to open up. And but I think for now, the second quarter, the data and the way that the algorithms, a lot of algorithms, look at things, it's positive, regardless of geopolitical issues and like that. So these and easy year-over-year comparisons are a factor. And here's a graph that I wanted to show that's showing spending, expected consumer spending over the upcoming year. And as you can see in this, the first quarter, this is, really skyrocketed and moved, from last year from lower left to upper right at a very, steep incline. So if this were to even happen at this level, or even a slightly lower level, that's going to be a huge injection of activity into the economy. And so some of the companies like retailers and travel and housing and restaurants and automobiles, people expecting to spend money at a much higher rate. And that's again, I think an example of how the computers and the algorithms operate that may not be so obvious. Now, the algorithmic and computer models aren't the only thing for the markets. Federal Reserve and government stimulus, certainly have a role, and it's been very helpful. Strong bond markets allowing the corporations to issue debt, which helps them function and expand. And again, foreign buyers of U.S. Treasury bonds is also important. Again, not to say that computers have total input on the direction of the markets, but it is, I think, a somewhat of an unappreciated part of the market that a lot of investors don't necessarily understand. So I want to finish this up. Today is May 28th, 2021. And the stock markets are all up year to date. The Russell's leading the way, up around 14%. Dow and S&P are up about 12. Nasdaq up 6.5%. During May, the Dow's up about 1.5%. S&P up about 0.5%. Nasdaq's actually down 1.5% in the month of May. Russell's unchanged. 10-year yield around 1.6%. Little change for the month, but up substantially from the beginning of the year. Lastly, I want to point out that the U.S. dollar has been weak, and a dollar can, influence a lot of markets, both fixed income and commodities and like that. So the DXY is the dollar index, and that ends up being, I think, something to keep an eye on. It looks like it's going to go down and retest the lows from earlier in the year. If it breaks that, may be a sign of a lack of global confidence in the dollar. Could be, but it's something to keep an eye on. So again, thank you very much. Appreciate all the kind words and encouragement. I'd like to wish everyone happy Memorial Day, and especially veterans, and try to remember those who gave the ultimate sacrifice. And we'll speak soon. Thank you. Goodbye.